So, if you are a home buyer or seller and you've been wondering why mortgage rates are rising when the Fed funds rate has been cut again, I'm going to break it all down for you here. And my VIP clients will be receiving this in the mail this week. And if you'd like to be on that list, just DM me and I'll get you a copy and add you to my VIP list. The Fed just cut the Fed funds rate, and mortgage rates you would think would decline, but they are actually rising. Let's look at the Fed funds rate here. It's been steady, steady, steady throughout all of 24 until the past few months. So in September, we had a drop. October, we had a drop. November, we had a drop. So this is the rate that appears in the news. And what people don't realize is this is the rate that banks will loan to other banks on a short-term basis. So this is not really an indicator of what mortgage rates should be, but because it's so highly announced on the news, the public thinks that their mortgage rate should be dropping in response to this rate. So just to show you what it has done this year, the high level was 5.5 in June, and then it's gone down to 4.5 in November. This is the Fed funds rate. So you think, oh, good, I'm going to save 1 point of interest on my mortgage. Not true. So let's look at the mortgage rates as they compare to the true benchmark for the mortgage rates is the 10-year Treasury yield. So this top graph shows you the 10-year Treasury yield, and you can see how the mortgage rates totally correlate to this metric. All right, so here we are in October. If we back up to August, we do see that initially mortgage rates did drop in response to the Fed funds rate being cut. But look at this. November, we dropped and mortgage rates went up. What the heck? It just seems counterintuitive, doesn't it? Well, the reason is there are many other factors contributing to the 10-year Treasury yield. So let's first look at inflation. So obviously, everybody knows that since COVID in 2020, inflation went crazy. The prices of everything skyrocketed, more than doubled. Home builders' costs went through the roof. And the Fed has been working hard and vigilantly to get inflation back down to around 2%. See how much stability we had for 6 years, from 2014 to 2020. Then COVID shook the world up, and they've been working hard to get us back. It looks like they've been doing a good job and the policies have been working. But unfortunately, that isn't the best thing for the housing market. So we, as realtors, were losing our minds these years. I did more volume in October of 2021, just 1 month, than I would normally do in a whole quarter. So it was like 3 times the normal volume. Of course, that didn't translate to 3 times the income because the stress was intense. And costs were higher, right? So what can you do? So the Fed is not quite where they want to be. So they actually did just announce that they are slowing that their previous estimates of 3 or 4 or 5 cuts in next year to they're not even sure how many cuts they're going to have, but it's likely only going to be half a point max. So 2 cuts is what they're expecting. So usually they cut a quarter point at a time, and then we don't know when that will be, because from the other chart you could tell that we let's go back to that real quick. They saved them all till the end of the year. So for 8 months, no cuts, and then boom at the end of the year. But then remember, that doesn't necessarily even mean that the mortgage rate is going to drop, because it's currently on an increasing, climb. Okay, so what does this mean? Inflation has caused institutional investors to demand higher yields on long-term bonds, including mortgage-backed securities. And what mortgage-backed securities are is when They bundle mortgages in a package and sell them to each other. And that creates an increased risk premium, and that's got upward pressure on mortgage rates. There's also low supply of homes for sale still, even though we're seeing more coming on the market, it's still low inventory. We're still in a seller's market. It's just going to take a little bit longer. And so instead of selling a home in a week, it's going to take months. Okay. And that's partly because people don't want to give up their low rate mortgages. So they're just staying put. So, what does that mean for this coming year? So, the Fed cut rates and mortgage rates decline in anticipation of the rate cut. So that's what happened between August and October. So right in September. And then now the average 30-year mortgage is at 6.72%, but the Fed is expecting mortgage rates to remain above 6% next year, but we will see those 2 cuts, in the Fed rate that should create some positive movement in the mortgage rate because of inflation coming back down and having more stability in the economy. If you wanna get on my, VIP list where you can receive all these updates in a timely manner, just DM me VIP, and I'll be sure to add you to that list and get you all the updates.